Hey guys, Jay here, smarthelping.com. So this is more of a template tutorial. I'm going to go through a sample projection for a plumbing business, and we're going to talk a little bit about how to change variables and test different scenarios, best case, worst case, different leverage scenarios. Before we get into that, let's look at where you can find this template. So if you go to smarthelping.com, under the General Industries tab, you can find this right under the Services bundle, this one here. Right here, plumbing, very affordable $45 template to create these financial projections for this type of service business. You can also get it in the service businesses bundle for $199, or obviously it's included in the all models bundle um, for $9.99. All right, let's get back into the sheet. So we want to create a projection. We're going to call this Plumbers LLC. Let's say it's going to be for 2024. We'll run it for a full 10 years. So 2033 is our end month. We will include exit based on trailing 12-month EBITDA, and we're going to say 8x. You see this exit value is negative right now because I haven't adjusted the assumptions. We're going to go cash sources, $0, debt, all equity for now, but I'm going to adjust some things. We're going to account for taxes. So let's go to the revenue assumptions. This is the main spot, and when I built this model, in my research, there's basically 3 service levels in the plumbing business. And so this model allows you to adjust. So let's say the model is going to start in 2024, but let's say we don't actually plan to start this business until maybe April. And maybe we want to start April 2024 for tier 1 and 2 services, and maybe tier 3 services. Maybe we want to start a little bit later, maybe in October of 2024. And I put a little description here. So tier 1 for a plumbing business is just basic residential services. Service consists of issues like clogged toilets, leaky faucets. This is your general, hey, something's wrong with my plumbing in the house. Can you help? So that's one type that we're going to scale out. Type 2 is intermediate residential service, involves more intensive tasks. Gas work is done repairing water heaters, a little bit more revenue per truck. And a lot of this is modeled after per plumber or per truck and what those unit economics look like over time. Uh, and then, so this is a little bit more. And then tier 3's bigger jobs. You're looking at, underground plumbing, sewer lines, water mains, gas lines, commercial or residential. So bigger stuff here. So 3 types we're going to scale out. And we're going to define some assumptions for each average job. So what we say here for tier 1 in this case, and just so you know, in all the financial models at smarthelping.com, I go through and develop bottom-up assumptions like this that are completely unique for whatever business it's for. Sometimes there's overlap and you could use some models for other things, but the idea is these are actually tailored to the business it's for, and the assumptions have been built to make sense in that scenario. So tier 1 services, let's say starting job count per month, 50. I'm not in this industry, so I don't know if that's a lot or a little, but let's just say we're going to start at 5. So we're doing 5 jobs a month starting in April of tier 1 services. And we're saying monthly growth of job count. So that means you start at 5 in April, and then you do 3% more in May, 3% more than that in June, etc. So it's compounding. And you can see this in the monthly detail here for tier 1 jobs. So you can see how it's going up every month. We're scaling up based on those percentages. So eventually, after 10 years, we're at doing 154 a month. Now, the nice thing about this is there's not really any major capital expenditures that come along with scaling more jobs. You're expanding into more areas. You have more people working, more trucks going. But let me see. What did I do for truck for CapEx here? Okay, so we have vehicles here. Just seeing what the assumption is on truck costs. So this is how many plumbers you've got, average jobs per plumber per month, so what they can do. Inventory's fine. So this would be like for tools and things that are required on these jobs. Just trying to see. So in this model, it looks like the CapEx is manual. So for this, in this case, you would just scale out your CapEx to match the plumber counts. And so, oh, here we go. Yeah, plumber truck head counts. So you can see how many you're going to need to accomplish your job volume that you've put up here over time. And so what you want to do is make sure if your plumbers are buying their own trucks, then it's not your cost. But if you're buying the trucks, you need to enter that here. And so you'd put, okay, well, I know at the end of year one, I'm going to have 5. And then in year 2, I'm going to have 10. So maybe I'll buy 5 at the beginning of year one. Let's say useful life on vehicles. I can't remember. Let's say we'll keep it at 15. But we'll say we buy 5. Maybe it's 250,000 for that tranche. So you treat these like tranches, not individual purchases of trucks. And we started in April, I believe. Yeah, April. So we got to buy trucks. So that's enough for, we're assuming $50,000 a truck, and 5 trucks at the end of year one. So there, by the end of year 2, so let's say somewhere around April of 2025, we do another round, and that gets you to 10. Then let's see, so you have 10, 14, 20, 28, up to 166. Now, I can't remember. So we got maintenance cost per truck, insurance here. So there are variable costs based on the count of trucks. So now, yeah, our CapEx is going to be quite large here. Taxes. So I'm going to look up, I'm actually curious here. Do plumbing businesses typically buy their own trucks for plumbers? So yes, many plumbing businesses purchase their own trucks or vans for their plumbers, especially if the business is a moderate to large size, which is what we're modeling. You have branding, uniformity. Yeah, okay, that all makes sense. So that's a big expense. So if you have these plumbers, we gotta scale out enough. So we gotta look at this. So you got 10 in year 2, and now, honestly, I'll just copy this over here to the CapEx tab. This is the count I need at the end of each year. So we've got 10. So what I'll do is just go, these are already 1 year apart. So I'll just scroll this down. So these are all exactly 1 year apart now. And this is 2024. Okay, so 2026, we need, and let's look at, so this is the total count, but we need to see how much do we actually need to buy. It would be this minus this. So this is the amount we need to buy in each period. So 5, 5, this is another roughly the same amount. 250, we're assuming $50,000 a truck. I don't know how much they are. Like, I'd have to go research, but this is just how you'd use the model. Now we're at 6, so 300,000, 8, and what we can actually do is just go this times, say, 45,000 truck, I don't know. So this is going to be our CapEx to scale with the operations. So we have, because you have to have enough trucks. Oh, did I do the wrong one? Oh, that's right. That's the newly added amount. Okay, here we still got some extra spaces. This takes us to 2033. All right, perfect. So we're buying our trucks. We got useful life here. So this is your monthly depreciation expense for each tranche, and these are all, in this case, these are all vehicle tranches. Truck tranche 1. So that would vary based on your level of activity, but you're going to see some of this is going to be able to be paid with working capital if you're scaling to that level. And I'm not going to change these assumptions since we just built all this to account for these, but I'll go through. So monthly job count, 3% per month. This is the average ticket value charged to customer. So obviously these services you're doing in tier 1, potentially all kinds of different, you know, costs to the customer. You're going to put your average here. So if you want to look at some data, let's say maybe 100 jobs or 50, and just look at what your average total value that you charge the customer was across those jobs for this type of work, and that's just your average. And then you could put average hours required per job, and then that, along with your average jobs per month per plumber, are going to drive your plumber and truck count requirements, as well as your variable costs, what you're paying your plumbers, and they're all on wages, hourly rates. And we could see how far did we get into this? I did count. So this is monthly hours worked in total, and then this is average hours per month per plumber. So you can make sure these kind of make sense with your inputs. So it's a bit of a sanity check there. And you can see the numbers here too. Average annual jobs completed, average hours per plumber. And that's just doing total average jobs per month per plumber divided by average jobs per month per plumber. So if you're doing 50 jobs a month and each job is 3, you're doing 150 hours of work in a month in this scenario. Monthly earnings is, again, this is just, we're running this off the monthly detail average in 190, which we've done a calculation here to figure out what do we do. Total wages divided by existing plumber headcount. Okay, so that makes sense. And then you've got total plumber truck head count for each type, and then the average hours per day. And this average hours, so this is saying your plumbers are going to be working an average of 5.8 hours a day based on how many working days are in a month against their total hours per month. So if they work 26 days in a month, their average is 5.8 hours a day for those days. And then again, you would want to adjust these to make sense for your organization and expected assumptions. But this is nice to see the sanity checks right here. So when you adjust these numbers, you can see what it actually means. So tier 1, 2, and 3 services, the assumptions all work in the same way based on starting job count, how your growth of job counts, the average price you're charging for them, average hours, and average jobs per month per plumber. So like on these, maybe they do less of these because they're higher service jobs, um, charging a little bit more. Now these again are just arbitrary assumptions. You're going to put in a number here that makes sense for your situation and the types of services you're doing for tier 2. And same with hours required per job. So we have this data in expenses. So here, what you're charging your plumbers, or what your plumbers are getting paid. Now this accounts for just their wages. We have separate assumptions here for payroll tax and benefits for each tier of plumber. So you're just putting this wage rate up here is just what they're actually earning, and you got to pay them. Average equipment cost. So this is saying for every job that a plumber does on average, what's the total equipment cost to the company? So the company will obviously provide those things, and they'll be different for each type of job. You've also got other variable costs per plumber per month, and this will just go off the total costs or the total count of plumbers / trucks in each tier, and what that cost is entered here, and you can adjust it over 10 years. Insurance, like I said, we're buying the trucks, so we're going to have insurance costs, maintenance per costs, and you could lump anything else in with this, and it'll just apply to the number of trucks times the monthly amount for each of the tiers of service. Payroll taxes, percentage of revenue paid with credit cards, credit card fees. Then here we have just operational overheads. Let's say we're starting in April, and we don't know what every situation is going to be a little bit different, but I'm just putting all these fixed costs starting in April, and you got all different fixed costs here. We'll go the same for, so that's sales and marketing, which would be mainly advertising. Maybe you have a marketing director if you're big enough, and you just want to put in the start month of that cost and the monthly amount over time. General and administrative, just any general managers that you have. If you have a CFO, if you have office rent, just anything that it takes to go into operating the business. In other words, there's a fixed monthly cost. You can adjust it each year. So you've got these to keep the business lights on. You got your variable costs. This model does a really good job at breaking down, really getting to the core of how you scale and what that looks like. Cap table, we're just going to ignore this for right now. CapEx we went through. Startup costs, maybe we do a website, an app, $100,000 reserve, and we'll just zero the rest of these out. Terminal value, we'll just put 100% here. This is just when we exit, is that all going to extraordinary income, or is it going to be applied to some of the trucks? We're just going to put 100% for that. Debt, so we don't know yet, but let's put in this environment 7% is reasonable on a loan starting in this case April. And I haven't put an amount in. I want to see first what this looks like. So now that I've applied all those assumptions, we can see what does our revenue look like over time. What are all our variable costs? What's our gross profit? And on this model, I've broke it down into total gross profit per job as well in that weighted average. But you can also see the gross profit of everything here. You got all your variable costs, other overhead costs, gross profit after other overheads. So maintenance, insurance, and then we've got our running costs here. So the main thing I want to see is, okay, what do operations look like? What's the cash flow look like? And when do I start making money? So in this case, based on all our assumptions, we are not making money. We start to a little bit here because we're growing our job count. So we finally, and it takes about 4 years to start making some profits. You can see that the cumulative cash balance here is negative, 3.194. Here it gets to even further, 3.7. Now we started making money, but we're still scaling. We still got to buy the new trucks. So there's these new truck purchases happening to be able to handle the level. And in this case, the profits are starting to chip away at that CapEx expenditure, but not enough because we're still, I mean, we're going down. Now at the exit, we do hit into the green, but in this scenario, and it's easier to see on the annual, um, we start making operational profit in this scenario in year 7. Now I've got pretty heavy fixed expenses built into here that are, for this, eh, you'd have more scale if this is what your G&A looks like. Um, with the CFO, CEO, like it's going to be a bigger operation, but you get the idea. And we start making good, operating profit. Our EBITDA in year 9, we're up to 1.6 million. But cash flow is still negative. It's almost to the green after purchasing those trucks. Um, but that's it. You can't scale without buying the truck, so you got to know what that looks like. Now, in reality, you probably have a rolling debt, not just a single debt assumption. So maybe you might have, let's say like $3 million in debt. The problem is, in this case, we have these big CapEx expenditures happening in the future, and the debt can only happen at one time. Uh, there are a lot of caveats, so let's try to get this at a more reasonable amount. So we zero these out because this, I mean, our OpEx is quite heavy still. Yeah, there we go. And then let's do something like, maybe 10. Okay, and then let's see, does this make sense? Insurance per truck, maintenance, probably realistic. That's realistic. It's fine. Wages, I haven't researched this enough to know the wages for each tier, but you'd put those in there. And I go back here. Okay, now let's look again. So we do see break even before exit, which is good. So that means now if I look at the monthly detail, and it's probably easier to visualize this. Let's see. Head count. Jobs. Oh, here's our free cash flow. So it's going negative, negative, negative. Then we get to a positive in year 2031, and we start operationally getting into profit, and then we're selling the business here in year 10. So this is good because I know, well, yes, I'm running at a deficit. I'm going to need some equity to get through that. Here in this case, 1.7 million, as well as 3 million in debt. Now, if we zero this out, it didn't go up a ton more, 2.4, because those CapEx expenditures are happening in the future. Let's say, yeah, it doesn't affect it that much. But it's still really good to see, okay, how much equity do I need if I don't take out much debt to, if we just zeroed this out, what's it going to take to get this business profitable. You see here in this case, the balance sheet, we solved for 0 cash balance, so this never goes below 0. And that initial equity will have enough to get us through. And again, I went high on the trucks. I mean, I'm going to look at this. I'm actually curious. What's the average cost? I'm just on ChatGPT. Average cost of a plumber truck. I was using 50,000. I don't know if that's realistic as a good number, or if it's high or low, or if maybe 35,000. Oh, no, 50, 30 to 50, they're saying. It depends, so. Well, let's go back to our CapEx here and look at that again. And this is just how you use a model. You start putting assumptions, seeing what makes sense, adjusting. The CapEx is a huge deal, though. Where's my plumber count? So here's my plumber count. And I'm actually going to... We're growing pretty exponentially, which, yes, that's another reason why the CapEx is, so high there. Where's my revenue assumption? Because I'm growing at 3% month over month for this long is quite intense for growth. You might grow a lot in the beginning, maybe even higher, like 5%, but then the amount of monthly, and this is monthly compounded growth, is going to be lower. Like, for example, if you just want to see, what if you did 10% in a year, or wanted to do 10% in a year, what would you have to compound per month? Well, it's a lot. It's, let's see if I remember this. It's this. Let me see here. 1 plus the rate, I believe, raised to 1 over 12 minus 1. So I believe that's the compounded rate to get to an annual amount. Let me just check that. So if you're growing at 0.8% per month, you're growing 10% year over year, I believe. Let me just do this. Oops. 100 times 1 plus that. Just because we want to know, like, what is realistic. Now, 3%, that's like, to get to 3, you'd have to grow at almost 45% year over year for 10 years is not really realistic. So let's put this back to 10. So 1, 2, 3, 4, 5, 6, 7. If I did the rate right, 1 times 1 plus the rate. Okay, so, oh yeah, I'm sorry, I went for 10 months. I gotta go for 12. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and 12, which is 10% of 100. So there, the compounded rate to grow 10% is 0.8. So let's say you can grow at maybe you can do that in year 2. 5% is really high, but we're saying maybe as you launch, you're growing a lot at the beginning. Then maybe it's like 3% is probably high. So 3% per year is 0.25% per month. So let's just apply that rate to all of these and see what kind of numbers we get. And then we'll go to our CapEx, and now we got to actually I can just reference this dynamically here just while I'm messing around. So plumber count is this. Oh yeah, so look at, I mean, this is crazy. Look at the difference. You can actually handle So you're not obviously growing as fast, but you're buying a total of 8 trucks for the whole entire 10 years. So, and you could do that up front. You could just say, okay, I want to buy 8 trucks times, let's go to the high end, 50,000. All right, based on our assumptions, you're not going to need more than that over 10 years. And the truck should last that long. So we're talking 400,000. Now, if we go look at our cash flow, okay, what's going on now? So we have the initial capex. We're making, we've got some other costs, operations. We're buying inventory every 3 months. Let's lower that down to month to month. So the inventory you're using, you're buying each month. I think it's more accurate. But it depends. Everyone will be different. So now we can actually see our P&L every period. So at these volumes, we're not profitable. Now again, we have to go look and does this make sense? So if we look at our annual, we're making, let's go to year 4, $1 million in revenue. We're paying 6,700 labor hours in that year. Wages 400,000, so that's 40%. Material costs, our gross margin is only 28% in this case. So is that feasible? And these are just high level things. If you figure out it's not, you can go back and adjust to low level. So 28% seems low to me for a service business. You're making average gross profit per job about 485. Still other overheads, gross profit after overhead. You're still profitable here, but it's not enough volume to handle these other overheads. And so, fixed expenses at 400,000, you can't support these fixed expenses. Now, what you could do, maybe we want to scale a little bit more than this. Maybe you go 5% year over year for a bit in the first couple years, and then maybe 4% year over year. And then we'll see what kind of number, because we really had barely any. Now let's look at our capex. Oh, re-reference that. Plumber headcount. So still not a whole lot of trucks you're buying here. I'm just going to keep this here until we're done with this. I mean, still hardly, you have enough trucks to handle this job count pretty easily. And if we go over to these assumptions, I mean, every job is average of 3 hours. Maybe let's put that up to like 5. And then for these, maybe these are a little bit longer jobs, maybe 10. And then these could be potential, well, $5,000, so they're about 15 times. So this is maybe 100 hours. Okay. Not a huge difference here. So we're needing, in total, 9 trucks. So maybe we go not much more. So 9 times 50,000, 450. What's the P&L look like? Still operationally losing money. Our gross profit is, in this scenario, $1 million, close to negative $1 million. And here, oh, well, yeah, because now the jobs are taking a lot longer, so, and we're not charging any more. Let's look at these revenues. So I know when I call a plumber to do something, it's usually $700 to $800. I'm putting 750 for this. For these other upper tier jobs, it's definitely like doing gas work, or I mean, thousands. I'm just gonna put, I mean, 2,500. And then these jobs are huge. These tier three jobs are gonna be way more than this. And these are like, if it takes a average of 100 hours, it's got to be, big jobs. Sewer lines, water mains. I mean, let's just put 25,000. I forgot on this the ticket prices didn't they seemed low, but I was just going with it. But yeah, now let's see what we look at now. Okay, yeah, now we're actually profitable every single period. Um, we're only losing money in the first few months here as before operations start. We have some fixed overheads and other things, but I mean, yeah, now your overheads or your minimum equity 600,000. Let's say you get a $250,000 loan, 372,000. We can see what discounted cash flow looks like on the initial investment. Now this is what happens when you go into the model and you start playing with everything and seeing, okay, what makes sense, what makes sense. After I got through a bit of the numbers, I realized, wait a second, I'm charging my value per job is way low. It's $200 a job, $300 a job here. That's not realistic, um, and it heavily affected the financials. Now, you can see how you can adjust this model as you go and see how the unit economics shake out. What needs to make sense for you to be profitable, cover all your overheads, based on all your different variable costs. I can see here, here's my operational profit in this case. And you want to just go through and validate all these assumptions for your case, see what makes sense. For what I was doing, like I said, at 3% year over year, 5% year over year is, I mean, sorry, not year over year, month over month is not realistic over that long of a time frame. No business is likely to grow that much, like especially a service business where you're not exponentially expanding. Even this is pretty good. I mean, if we look at what do we have here? I mean, you're just doing a slow growth of revenues here. Now, if you do expand faster, it's just going to require more risk. So you have to buy more trucks more of the time. If you time it out, you can try to adjust the assumptions in this case. Every model is different, but for this, so that you are doing more jobs after you've saved up some working capital. So like here, I can see, um, you know, in month 24, I've got about 2.2 million in working capital. Well, maybe I now in year three start ramping up faster, and I purchase some trucks here in January 2026. So I go to the CapEx and say, okay, January 2026, maybe we buy another 450,000 of trucks. And if I go to my monthly detail, that actually doesn't cut into our cash requirement because we've already saved up some capital here. And that's how you can you can model getting ahead of uh, the working capital requirement by waiting a bit, running profitably for a while, saving up, and then, okay, I want to expand, use that working capital to buy some more trucks in this case, and now we can essentially double our volume because we bought twice as many trucks. Um, so, maybe I go, and if you don't want, these are kind of high level assumptions. If you want to try to manually look at the numbers, you can just say, well, I believe these all run off of here dynamically. So I could just say Maybe I want to do 16, 40, and 28 jobs now. And do that for a bit and then scale up again and just override, because all you're doing is overriding these percentages here, these month-over-month growth percentages. You're not messing anything else up. And you can see here, if we go down now, look, we've had that one CapEx spend here. And now instead of doing 172 a month in free cash flow, 172,000, we're now doing 360. So that's one of the main uses of these models is you're trying to account for a whole bunch of different variables at once and seeing what does that look like for cash flow purposes. All right, I think that's good for here. If you want this, again, the template is only $45 to buy, one-time fee. I do custom work as well. If you want to check out smarthelping.com. You can hire me here at $165 an hour, and I could build stuff custom or go over things with you or whatever. And the models, like I said, this one's under the services business. There's a lot more like this, but they work, with their own way, with their own bottom-up assumptions, and just lots of value here if you were trying to validate some different businesses and plug in different assumptions and see what makes sense. Here in the case where we're looking at this model, we could quickly see, well, it wasn't feasible to only be charging $200 a job for these and $300 for these, so it had to be higher. So you're trying to figure out what can you charge that is competitive, but also allows you to make a profit and cover all your expenses. And there's a lot of variable expenses with the plumbing business. Like I said, you've got your wages, you've got different costs for trucks, you've got different equipment costs per job that you got to cover, and then you're going to have overheads and everything else. So, alrighty, that's all I got for you. Like and subscribe, and I'll see you guys on the next one.